Welcome to the RE Source. Once again, our good friend who needs no introduction, who's been on the show a million times, and whose update yesterday prompted me to call Barry and be like, man, you are hitting it out of the park. It's reason 702 as to why people need to be in the MBS Highway family, because Barry keeps everybody in the know. There's a lot going on right now. And Barry, you talked about the Fed line yesterday, and it was a provocative topic. And so I want to unpack that with you today. But first, thank you so much, man, for being on the show for the millionth time.
It's always great to be with you, man. You do such good stuff.
It's so good to have you. It's been a while. There's been a lot going on recently. And yesterday, let me frame the talk real quick for realtors, consumers, lenders. So yesterday, again, if you guys don't have an MBS Highway account, you need to go get it. Even if it's not just about mortgage-backed securities and mortgage rates, it's about everything, the economy, the markets, housing. And you talked about the Fed and the fact that they've been buying mortgage-backed securities. Guys, I don't want to get too technical, so you guys zoom out. But essentially, if the Fed wasn't buying mortgage-backed securities for quite some time now, and Barry can talk about this, and he has some crazy stats, the markets would look much different. This would be a domino effect. Rates would be much higher. Housing certainly wouldn't be in the position that it's in today, and thus the economy, I feel like, wouldn't be in the position it's in today. So the good news is it's been great for homeowners. Been able to finance their house really, really low. It's been great for home buyers. It's been great for lenders and realtors. They probably had their best year in 19, 20, and 21. Those are amazing things. But Barry, you talked about some scary numbers about how the MBS market was $4 trillion last year, and the Fed was half of that. So that's all the good news. But is there a other side to this coin that we should be worried about? I mean, that's if they weren't in this, and they weren't running the strategy for so long, I think the markets would look much different. So what should we be concerned with, Barry?
Well, the market would look very different. They did buy 50% of all new mortgages coming out in 2020. They've purchased so far year to date 40%. So they're an enormously important part of what's going on in keeping rates low. They're a very big player. Now, if they were to buy zero, we're not saying that's going to happen, then we probably see interest rates move a little higher, but not dramatically higher, because then the foreign participation comes in. Rates around the globe are, for the most part, much cheaper than they are in the United States, much lower than they are in the United States. So you'd have people searching for yield, want to participate, and especially at a little bit more attractive yield that's out there. Remember, mortgage rates as low as they are, they still look a lot better than the negative rates that a lot of people have as options in other places of the world. So, and they're very safe, especially with the strength of the housing market. But first of all, we'll hear the number that the Fed's buying $40 billion a month, right? And that's what we hear over and over again from many well-respected economists too, but it's not even close to that. When you dig deep, and it's hard because the Fed has become more clandestine on this, is that you find out that it's significantly higher. In 2020, when they started to say we're buying $40 billion a month, started in March, that's 10 months. 10 months of that should have been about 400 billion. They bought 5 times that amount, $2 trillion, half of the mortgage market that was out there. In 2021, through the first 6 months of the year, so through June, if it were $40 billion a month, if it is what they're saying it is, then it would be $240 billion. That's 40 billion times 6. But it was $680 billion. So, a far larger number, well over $100 billion per month on average. They're telling us they're buying 40. So where's this coming from? They're claiming that because this is reinvestment of, there's loans that are being paid off, so they're buying what? I mean, that argument just doesn't hold water. That's just BS. Okay. Yeah, that's like me saying, in the GDP report, let's not consider food because I'm just replacing the food that I've consumed, or something that wore out. I'm just replacing it, so you can't count it as a new sale, right? Whatever wore out, my toaster broke, so the toaster I'm buying, you don't count that because I'm replacing it. It's a ridiculous, stupid, idiotic argument, but the Fed's making it and everybody's buying it because they think that the Fed's buying $40 billion a month. They're not. It's much bigger than that. It's well in excess of $100 billion a month. So I don't know what the other way to put it. It's just not honest. Now, here's the thing, is that there's a lot of talk about tapering. And people are freaking out. What happens when the Fed starts tapering? We get much higher rates. So first of all, the Fed doesn't have the guts to start tapering anytime soon. They're under this BS that, look, the market for employment, it's not really back. The market's back in employment. You get 9.2 million jobs open saying, please come to work, but people are getting paid to stay home. Now, the states that have stopped doing that, about half the states have, they've seen big job growth. Here's the interesting thing is their unemployment rate, at least over the short term, has actually gone up. Why? Because if you don't look for a job for 4 weeks, you don't get counted. So now these people say, I'm not getting paid anymore to stay home. I'll go look for a job. And as they begin looking for a job, they enter as an unemployed individual before they weren't counted. So the unemployment rate temporarily goes up, but the jobs start to grow even while the unemployment rate goes up because a lot of these people are finding jobs. And Labor Day is when it all stops. So people are going to come back and rush back to try and find jobs. So the unemployment rate, interestingly enough, will go up. Fed will say, oh, we can't do anything with tapering, right? But the job creations will be much greater. So this will shake itself out, and maybe the Fed starts to do something in 2022. But this is why they put us through these boom and bust cycles. The Fed does that, whether it's housing, whether it's the stock market, whether it's the overall economy. The Fed is a very poor way of handling the economy. It's sad to say, but most of these people have never had a job in the real world. They don't understand how these things work. They're just academics. So unfortunately, when the Fed starts to do something, oftentimes they're very out of touch or very delayed with the real world. Now, back to tapering, if they say, okay, we're going to taper, 25% of what we're buying 40 billion, we'll taper 10 billion a month. That seems like a lot, but because they will not touch the reinvestment, which is the lion's share of this, here's what it would have looked like. For argument's sake, say the Fed started tapering at the beginning of 2021. Well, $10 billion a month, that's $10 billion less times 6 months. So instead of 680 billion, it'd be 620 billion. That's a much smaller decrease. It's less than a 10% decrease than what people would say, oh, they're going to taper 25% of the amount. Sounds much more harsh. It'll be much gentler. So while there'll be a lot of media, there'll be a lot of initial fear, the result will be that you won't see much difference in the way interest rates behave. Very little.
Interesting. So when you're talking about, and this is an obvious question for you, but just maybe consumers watching, you said the Fed's kind of concerned with tapering, and they're a little bit fearful of doing that. Again, obvious question, but why? Like, what are they concerned about?
Well, they're concerned about the housing market being so hot. That's what the drumbeat is. We've heard now 4 Fed members talk about this, and a couple of them are voting members this year. So it is important. It carries a lot of weight where they're being pressured, and you can see it in the press conferences that the Fed is being tagged with, hey, there's a housing market that's too hot. It's crowding people out. First-time homebuyers can't get a home, and there's a lot of complaining and bitching and moaning about the housing market, which, by the way, is really nonsense. Yes, the Fed has contributed with low rates, but this is really a supply and demand issue, as mostly anything is. Yes, you're inciting more demand by allowing more people to qualify with low rates, but rates wouldn't be that much higher. They'd be higher, but not that much as far as participation would come in. The thing that we have to understand is what's the alternative and why is it so bad to have appreciation? It's not all bad. I will agree that it's sad for a first-time home buyer, that it's hard to buy a home. It sucks to buy a home. The University of Michigan came out with a headline saying, worst time to buy a home, consumers are complaining. And they have every right to complain because it sucks to buy a home. It also sucks to diet. It also sucks to exercise. But you know what? The results are great, aren't they? And we do them. And the results have been great for home buyers. Think about how they have been rewarded. Home values have gone up 16.6%. 66% of America owns a home. It's not all bad. I'm not saying this isn't too hot, and I'm not saying I'm not empathetic towards those trying to buy a home. But let's not throw the baby out with the bathwater. People have created a lot of wealth. They can pay down debt. They feel better. It's helping to the economy in general. And it helps people with their retirement or future plans if they wanted to use that equity that they're building out of thin air wisely. So it's not all bad. I wish it were a little bit more tame than it has been over the past year, but this is what we're going through right now. So as the Fed comes under pressure for this, what they also don't realize is everybody points to the bad, but they don't think about, okay, it's okay to bitch about this, but what's the alternative? I mean, are you going to pitch a tent? Because guess what? You know what rents are going up? This is a shocking number. So Invitation Homes is the largest landlord in the United States. They have 80,000 single family units that they're renting. Guess how much rents have gone up on new leases year over year. So this is equivalent to if you're buying for a home last year versus this year. While home prices have gone up an extraordinary amount, 16%, leases have gone up 14%. So it's not as if you're getting this bargain by renting, okay? It's what's the alternative? But here's the real thing that nobody points out, right? Is that renewal leases are up 5.8%, and that's every year. If you purchase a home, okay, yes, it's a little more expensive than renting, but you don't get that rent going up roughly at 6% a year every year after that. It might not be that much every year, but at least that's what the rates are right now. Now, if you have an adjustable rate, it might be different, but the vast majority have fixed rates. So the principal and interest will stay the same. Certainly, it's possible the taxes go up, but as a proportion of the payment, maybe the taxes go up 2%, and maybe that represented 30% or 50% of your overall payment. So it's a 1% increase based upon the taxes going up or less. It's what I'm trying to say here is it's a great deal to buy a home. It's hard, it's difficult, but the rewards are really there for you. Now, I want to cover a couple of other things because news headlines that have continued to come out trying to bash the housing market, and Diana Olick is the poster child for this. She's been wrong. She's been wrong for 9 years. We had some fun, and we posted we found you can find them right now. Just look it up. Just Google, headlines for Diana Olick, bashing the housing market for the past 8 years or so. It's easy to find. We posted like 10 of them that we found in like 3 minutes, and we just had some fun chronologically through the years. How she's in 2012, 13, 14. Don't buy a home, rent. Home values in 2050 will not go up. It's peaked in 2060. Obviously, she's horrifyingly wrong. But you think about the damage that she's done to people that have listened to her, right? Just incredibly bad advice. People like Peter Schiff, the same thing. And there's many out there. Just horrifying advice. When you take a look at what they're trying to say now, and Diana Olick's last headline just a couple of days ago was housing boom is over. And when we look at this, we have to understand how really off kilter she is and how so many people are. We get headlines like pending home sales. Now, this measures signed contract on existing homes, down 1.8%. So bad, right? Well, the previous month was up 8.4%. I mean, inventory levels are down 20%. It's harder to find a home. Yes, home values are higher. Yes, that puts more of a strain. We understand that. But the demand is that this is not, Ryan, if you sell your home, well, we understand this. Home values are determined based upon supply and demand, like any other market. So we have a ton of demand. The only way home prices go down is if the supply overwhelms the demand, causing prices to drop. That's any market. That's just economics 101. Do you think everybody's going to sell their home? And then remember this, if you sell your home, where are you going to live? And if everybody goes to renting, that will actually boost home values because you're occupying units, making it more scarce. But if you are going to buy another home, well, then have you really solved the supply and demand equation, or you just kept it neutral? Only if we have a rush of homes being built, much like we saw in 2006.
And that's not coming anytime soon, man. Like what you're talking about, I can't see that for years. I mean, which is great for housing and great for people that are in housing. Like that's not happening anytime soon. We have such a demand issue right now that supply, excess supply. I can't see being an
You're
issue.
so right on that, and this is what we have to think about: just the rules of supply and demand. Now, I'm not saying that home prices may flatten out, and even in certain areas because it's very geographically sensitive, that we could see some changes. But this isn't going to be a precipitous drop in home values that we're going to see across the nation. One other thing that did come out is the Mortgage Bankers Association reported that purchase applications on a year-over-year basis were down 18%. And that seems pretty scary. And the media ran with that. Diana ran with that. But they don't break down the numbers. Let's think about what these are. Mortgage applications. This is not all people that buy homes. There are a significant amount of people that buy homes for cash. So when you look at the 18% change year over year, where were we a year ago in cash applications? They represented 16% of the market. This year, 24% of the market. So the real number is a drop. It's not 18% though. The real number is there's a 9% drop, but inventory is down 20%. So it's harder to buy a home. Yes, home values have gone up, and that is going to make it harder too. Not saying that we are not without headwinds, but let's at least get the numbers right and understand what they are. Let's not sensationalize them. Let's not just say, okay, month over month, pending home sales down 1.8, it's horrible, without saying, but the previous month was up 8.4. The world didn't change in 30 days. It's not like interest rates skyrocketed and now we have a different. We have to try and understand this in an overall picture.
So let's wrap this all together and kind of last question for you. Like, give me your predictions, which I feel like based off what you've said are going to be pretty easy for the second half of this year. But before we do that, let's look at the worst case scenario because everybody's concerned with Fed's going to taper, sky falls. And yes, there are ramifications from Fed tapering, but what I'm hearing you say is not going to be that big of a deal. I'm not hearing you say rates are going to go to 5 or 6% because of tapering. So that's good news. Like this needs to happen first of all, um, but the good news it's not going to spend like put the markets in a tailspin. Do I hear you right on that?
You're right. You're 100% right. And in fact, as you know, I've been saying this. I think that we're headed for recession-like conditions. Let's look at gross domestic product, a very important measure of the economy. It was estimated to come out at 9.2% for the first look at second quarter GDP just a couple of days ago. It was extremely disappointing. The day before the announcement, they reduced their estimate from 9.2 to 8.4. So they're already saying, yeah, maybe it's not going to happen. But it came in way below that at 6.5. All of this crazy stimulus that we've done, the effects wear off. And just like any drug, the same amount of the drug has a less potent effect every time. There's this diminishing returns. It's very true with stimulus. So now we believe that just like we saw in 2020, where the stimulus by the fourth quarter had worn off, that by the fourth quarter of this year, the first quarter of next year, we will see very low numbers in GDP. That unless more stimulus is, you give another shock treatment to the patient, unless that is administered, and I don't know how much tolerance this country has for continued stimulus and continued debt levels, then the excessive debt takes over, slows down economic conditions to the point where you'll probably get in 2022 either recession or recession like conditions. So, as crazy as this sounds, even in the face of tapering, I think that we will more than likely see interest rates lower in the future than even they are now. Perhaps the lowest we've ever seen is the direction I think we're headed based upon the amount of stimulus that's been given, which turns into debt, which turns into slow growth, as well as effects around the globe that we're seeing. There's just pressure for lower rates. Technology pressures rates lower. Yeah, we got some inflation right now. Some of it'll be transitory, some of it'll stick, but overall rates are headed lower. Not in a straight line, by the way. So if rates go up, don't say, oh, you were. Yes, they're going to go. They're going to be spikes, but imagine an escalator and a yo-yo. The escalator's heading lower on rates, but if a kid has a yo-yo on that escalator, there are periods of times where it will go up, but the general pressure is towards lower rates.
One of my favorite analogies of yours, but man, you've made some big, bold predictions over the years on our show, and we've taken those timestamps and brought them back months or years later. I feel like the one that you just shared with us might be one of those moments again where we go, look, Barry called this again, and here's the timestamp.
Well, let's see. I mean, nobody's always knows what's going on. There's a lot that could change, but that sure seems like a most likely scenario to us that interest rates will be pressured lower. What does this all mean for housing? Unless something dramatically changes, we would love to see home appreciation levels calm down. I'd be much happier if it was 3 or 4 or 5 or 6% appreciation. I don't like 16% appreciation. Let's just hope that let's just hope it settles out. But based upon what we're seeing, I don't think there are forces out there that will cause that. I think those forces of high prices being the main one could cause home values appreciation to decelerate. But if you're going 100 miles an hour and you're going 40 miles an hour, that's still going forward as opposed to going in reverse. So this is what we have to understand. The media will make much of decelerating home appreciation, but it's still home appreciation, and the deceleration would be good to be healthy.
And Barry's saying that recession like, coming, and I don't know if you're saying an actual recession or recession like,
Good.
isn't the sky falling, guys. And if you've ever watched Barry or the show, you know that housing performs well typically through recession. So this isn't like, oh my goodness, chicken little skies falling scenario. It's part of the markets. It's cyclical. It needs to happen. The good news for originators, realtors, homeowners, and buyers is, I think, and for what you said today, Barry's outlined it very well. Housing's going to remain strong. If you're in the business, which I'm so thankful to be in this business, I love it every day, even on the toughest days. I love this business, man. I love it, and I'm so thankful to be a part of it, guys. I see a bright future for us for all the reasons that Barry just laid out. And that's the great news for today. No matter what happens, tapering, recession, appreciation slowing down, which Barry said should happen as well. It's all good news, guys. It's all good news. So Barry, thanks for outlining that. Anything else to wrap it up before
No,
we head
you,
out?
you said it really well. We are blessed and fortunate that we picked this industry. I think that the overall forecast is exactly as you said. It should be pretty good. There are some headwinds in things that are out there economically, but really, I think most of the headwinds will come from the fact that a lot of public money has come into our industry. It used to, especially on the mortgage side, used to be kind of a secret. Now it's become a lot of younger people are getting into it. That's healthy too. That's good. But I think there's more hands in the pie. There is the susceptibility for technology to pressure and price wars to put pressure on. So long as you don't look at this business as a commodity, so long as you look at this as something where your expertise and advice will be valuable, and you can make sure you do the work and have the resources to do those things in a way that creates value for people. Because the best rate on the wrong strategy is much more expensive than a competitive rate on the right game plan. So long as you have that mindset, you'll be able to be in pretty good shape for a long time.
Yeah, Barry, you guys need to go back and watch that last 2 minutes because Barry just gave you the strategy and how to preserve yourself and protect yourself against like maybe a margin compression war that may be coming sooner. And you just talked about being an educator, so that it was gold, guys. So you need to go back and watch that because we're not there yet. And that dirty word of margin compression and price wars has been thrown around. At some point, we will be there. And I'm telling you, you don't want to go to bat with just being the lowest rate possible. You got to be an educator, and that'll help you withstand that when everybody else is just chasing, the race to the bottom. Barry, man, thanks. We went long again today, but it's only because you got so much information and you're so awesome just to take time out of your day to share it with the Resource Nation. So for that, man, we thank you so much.
Oh, we love you, brother. Then thank you everybody for watching. Appreciate you guys.
All right, buddy. Well, we'll see you next time.
Bye.